Good morning, everyone. Good morning.
Good morning, sir.
Good morning. Yes. So, shall we start the session because it's 10:10?
Sir.
Okay. So, yes, we are discussing how do you value equity, and we have discussed various methods of valuing or the valuation of equity. So, first we discussed. I'll just go to the previous slides. First, we looked at the balance sheet methods, but that are not really relevant because they capture generally the historical value. Then we looked at the discounted cash flows method. In discounted cash flows method, first we looked at dividend discounting models, right? So the value of equity today comes from the expected dividend in the future. Now, dividend could be constant every year, forever. Dividend could be having multi-stage growth. That means in the first few years the growth rate is different, and then the growth rate is different for the later years, and maybe then perpetuity, right? So at different stage the growth rate is different. That's why we are going to value equity at different stages, right? And then we started discussing the free cash flow models, where we talked about FCFE and FCFF, right? Let us complete that today. And we have also discussed how do you value equity based on comparables or based on relative valuation models, right? So just let us just go through this. We discussed this, that in discounting cash flow models there are two approaches. We can use FCFF, that is free cash flow to the firm, or we can use FCFE, that is free cash flow to the equity shareholders. When we use FCFF to value equity, we will, because this is the free cash flow available to the all the stakeholders, that is debt plus equity. We should discount this by WACC, because weighted average cost of capital is the cost for all the stakeholders. So when I discount FCFF by WACC, I get value of firm, and when I minus value of debt, then I get value of equity. In case of FCFE, I need to discount free cash flow available to the equity shareholders by cost of equity, and that would give me the value of equity directly, right? So these are the two approaches. We also discussed how FCFF and FCFE is calculated, right? So in case, because we are talking about free cash flow available to equity plus debt, we will start with earnings before interest and tax, and this is accounting earnings, right? So first we minus tax, we get rid of the effect of the tax, so the remaining amount is available to the firm as profit. Then we add all the non-cash transactions, all the non-cash expenses, that is depreciation and amortization. Then if company has investment plans, company will allocate the money for investment plans, that is working capital as well as capital expenditure. Then the remaining funds are available to the firm, and that is what drives the value in this case, right? So using FCFF, you get the value of firm minus debt, that will give you value of equity, that we discussed. In fact, we spent enough time on this last time, uh, right? That why do we add depreciation also. The second approach is FCFE. In case of FCFE, we start with net profit after tax. Then we add a depreciation because that is not going anywhere. That is not an outflow. So the cash is more with the company because depreciation is a non-cash charge. Then we adjust for capital expenditure and changes in working capital, and then we adjust for the debt. Now we had a lot of discussion about why we are adding debt and then deducting the debt. This is the amount repaid this year, and this new debt is raised this year, and this money could also be used to fund the capital expenditure. A lot of you were asking me, sir, why we are adding and then deducting the debt, and why debt, because debt funds are not available to the equity shareholders. Remember, the moment you are following the covenants of the loan, the promises of the loan, if you are paying interest periodically and EMIs and whatever, right? The moment funds comes into the business, those funds are available to the equity shareholders only, because they have power to use for investing in different projects, right? So that is why we are adjusting for that. So the moment funds are coming into the business and you are not breaking any contract, the funds are at the disposal of equity shareholders. That's why we are adding. And you can also say this way that this debt funds are also available to fund capital expenditure. That's why we are adjusting, right? So that is FCFE, free cash flow.
Sir,
Yes, please ask question, please.
sir, what is the difference between both of them? What is their importance and significance of
Okay,
calculating both?
okay. Forum, let me tell you one thing. let's say you are a debt holder, you have given a loan to the company. Which profit you would look at? You would look at the net profit after tax available to the equity shareholder. You would look at EBIT. Tell me. You would look at the profit from which you are also going to get your share, right? Are you getting what I'm saying? You are going to look at the profit
Yes.
which is available, which is also available to you. The moment I distribute the interest, you have nothing to say in those funds because I have distributed your interest. So when we look at equity plus debt together, you always look at EBIT and then adjustment for taxes, because that is also your claim as a debt holder. EBIT is also includes your claim on the earnings, right? The moment I minus interest, the funds are available to the equity shareholders. So in case of FCFE, we start with net profit after tax. So that is obviously after interest. So the difference here is that in that case, we started with EBIT and then paid taxes. So you also have a claim on that as a debt holder. In case of FCFE, your claim is on the earnings after tax, because equity shareholders receives profit or share of profit, residual amount, right? The remaining amount, not the entire amount. So that is the only difference, that you, in one case you start with EBIT and adjust for taxes. In this case you start with net profit because taxes are already deducted, so we don't need to adjust for it, right, Forum?
Yes, sir.
Yes, yes. So please read this formula. That's why I shared a lot of I shared what you have to read, and I have also shared one link that may also help you understand what is enterprise value. So please read and also read textbook, of course, because a lot of stuff is already there in the textbook, right? So then let us talk about terminal value, right? Because see, we say that the value of equity today is the present value of expected cash flow to the equity shareholders. That is what we say. And we can calculate that using FCFF model or FCFF approach or FCFE approach, right? So the question is, what cash flows we are talking about, or can you really forecast cash flows forever, guys? Please, I want participation. Can you really forecast cash flows for 15, 20, 25, 30 years? Because the value of equity comes from all the future cash flows, but you cannot forecast cash flows for forever, right? Because the future is the larger the period of estimation forecast, the more risky it gets, right? So yes, tell me. So then how do you calculate the value of the firm? So then what you do is that, based on your experience, you estimate the cash flows for certain years. Let's say in this case 5 years, right? So the present value of, a lot of students are joining right now. Okay. The present value of all this 5 year cash flow, and then beyond 5 years, let's say that is the horizon period, the period beyond which you don't want to estimate, because for this industry or for your business, expecting anything after 5 years, or forecasting anything after 5 years becomes risky, right? So what you do, then you calculate terminal value, and terminal value captures the value of all the future expected cash flows at this horizon period. I'm again repeating, right? So what is terminal value? Terminal value is the present value of all the future cash flow at horizon. This is the horizon, means beyond this you do not forecast, you don't want to forecast. So the terminal value will calculate the present value at this time for all the future expected cash flows based on the growth rate that you have in your mind, the growth rate that you expect from this cash flows beyond horizon. So basically, terminal value is the present value of all this cash flow beyond this time. So what is the value of the firm in that case? The value of the firm is the present value of all this forecasted FCFF, that is the free cash flows to the firm for 5 years or 6 years horizon period, and plus the present value of terminal value today. So the total of that is enterprise value or value of the firm today. Yes, please ask questions, because this may I don't know whether you have heard this terminal value term or not.
So can you repeat the terminal value? What does
Yes,
it
yes,
mean?
sure. Can I use a very vague example? Every day you see the sun setting, right? But so after the sun is set, you cannot see sun, but that does not mean the sun is not there. Similarly, when we talk about firms and we talk about cash flows, we forecast the cash flows for certain years, but that does not mean that after those certain years the cash flows don't exist, right? So how do you consider them into account as well, right? Because you don't want to forecast forever, and after some time you want to give up on certain growth rate. Let's say you are expecting 10% is growth rate or 15% is growth rate for 5 years, but then you are not expecting lots from this project, maybe a MacBook project, maybe a iPhone project, particular iPhone project, because you don't want to sell those iPhone after certain years. So what you do is that you for that project or for that company, after that horizon, so let's say the horizon for this industry, and let's say you don't want to forecast beyond 5 years. So let's say the horizon is 5 years, and after this there are cash flows, but you don't want to forecast because it's anyways very risky to capture them in absolute terms. So what you do is that you calculate the terminal value. The terminal value captures the present value of all the cash flows beyond this horizon. This is the horizon. This is the period for which you have forecasted. So anything beyond that, any cash flows beyond that, captured by terminal value. So the terminal value is the present value of expected cash flows beyond horizon. So all these cash flows from sixth period, 6, 7, 8, 9, 10, it could be 20 years or it could be perpetuity, right? And based on the period and based on the cash flow you expect, the terminal value formula would change. But the idea is that the terminal value would capture the value beyond this time, right? So terminal value is the present value of all the cash flows beyond horizon, forever, maybe forever, right? So you know the 5 cash flows, and now you know the terminal value at time 5 at horizon, right? So what is the value of the firm today, or enterprise value of the firm today? The firm value of the firm today is present value of this 5 cash flows plus the present value of terminal value. Why present value of terminal value? Because the terminal value captures the value at horizon time 5. So in simple words, let me tell you in one thing. Let's say you are working in a company, and because the company has an amazing idea, it expects 15% 20% growth in the first 5 years, and then it expects only 5% growth because the company may be matured. Just a vague example, right? And maybe forever, because we don't know how long the life could be. Let's say 5% is growth rate. So so uh, the growth rate that you are forecasted for the 5 periods, that would be captured here using this formula. So 1, 2, 3, 4, 5 cash flows discounted at the cost of WACC or cost of the firm. That would give you the present value of explicit FCFF, and then any cash flows beyond this, let's say 5% is growth forever, would be captured through the terminal value, would be called terminal value, because it will capture all the cash flows beyond this point, right? And that is the terminal value. I hope this is clear now, Shaurya, please.
Yes, sir, it's clear.
So please, I would also request you to read. So there are multiple approaches for calculating terminal value. The terminal value can also be calculated using liquidation method, that you assume that the company would not exist after 5 years. Maybe because you are a private equity investor, you have invested in this company for 5 years, and now you are going to sell this after 5 years, because that's how private equity investors make money, right? They always invest in only those companies where there is a lot of growth potential. But the moment they do not have advantage after certain years, they sell it off. So the terminal value could be coming from capital gain, could be coming from liquidation value, or could be coming from maybe some expected cash flows in the future, 5%, 4%. So it depends upon who is valuing, depends upon what kind of company it is. You use the formula for terminal value, right? We will do one question, don't worry, we will do one question. Then I think the next question is about that. So that is called enterprise value. So enterprise value is like value of the firm minus the value of debt is value of equity, right? So that is, you can see here, the price today is the present value of cash flow still horizon plus the present value of terminal value, right? Okay, let us do this question, because this question used terminal value as well as free cash flow also. Please let us read this question. I would take your help for this question, so please be very participative. Fincher Manufacturing has projected sales of 135 million next year. The costs are expected to be 76 million, and net investment is expected to be 15 million. So you are given information about revenue, cost, all the costs are included, and also given the, okay. Can others hear me, guys? Others can hear me, right? Can others hear me?
Yes, sir. Yes, sir.
So Shruti ji, please, if you uh, uh, could you please unlock the meeting so that I can join from another device? Okay, let me. So, Shruti, you try to join because the participants window is anyways open. So I will admit you for sure. Don't worry, right? The moment your name pops up, I will admit you, Shruti Chhabra, please, huh? And then if some issue is there, please let me know in this chat box. Yes. So 135 million is the revenue, 76 million is the cost, and the investment is also given. Please focus on this, right? Because a lot of students were asking me that how do we know future? Because the value comes from different departments. So based on the data available in this case, each of these values is expected to grow at 14 percentage the following year, with the growth rate declining by 2 percentage per year until the growth rate reaches 6 percentage, where it is expected to remain indefinitely. That means every year the growth rate is declining by 2 percentage till 6 percentage, and the moment it reaches 6 percentage, then it is forever. The growth rate 6 percentage is forever. So please keep this in mind, that the growth rate is changing every year, right? Till it is reaching 6 percentage. There are 5.5 million shares stock outstanding, means shares with the public, shares with everyone, and investors require a return of 13 percentage. So cost of equity is 13 percentage, you can say, on the company's stock. The corporate tax rate is 40 percentage. So what is your estimate of the current stock price? Guys, tell me, how do we go about this? Can someone help me? Yes, Shruti, I'm allowing you now. Yeah. How do we go about this question? Please participate, guys. You are given the revenue and cost, and you are also given net investment. So we can use the FCFF formula, right? Please, someone participate.
We can use FCFE now because equity shareholders के लिए current stock price तो
So
equity
whether I call it FCFF or FCFE doesn't matter in this question, because there is no debt,
हाँ right.
right? So because the debt would value would be zero. So both are fine, beta. Yes, you are right, absolutely right. So yes, Mayur, now how do we go about this, beta? Tell me, how do I draw the picture to value stock, please?
Sir, it would I think start with, as we have studied in FCFF, so EBIT first we have to calculate, that is earning before interest and tax. So for that, sales minus the cost that we have invested, and we'll get the earning before tax and the after tax. So effect देना है तो उसे
And
tax part.
then net capital expenditure, right? That is also given. So net investment every year. So as you know, you could see from this screen. Thank you so much, Mayur. So you are given the revenue for year one, and then it is growing at certain rate, 14 percentage, I think, right? Every year, right? And the cost is also given for the first year at time one, and that is also changing at a 14%, 12%, 10%, etc., etc. So sales cost and investments are changing at this rate. The growth rate is given to us, and at 6 percentage, after 6 percentage, it is 6 percentage only forever, right? So sales minus cost changing at this growth rate given to you. Earning before tax minus tax is net income after tax, minus investment, that is the free cash flow, equity you call it, or firm, doesn't matter, right? So you know the free cash flows available for each of this period, right? Okay, so now let us read the question. The question is, what is your estimate of the stock price, right? So tell me. So there are two approaches. Whether I go with the dividend formula, or whether I assume that all the dividends are distributed, let's say, or all these dividends are available as free cash flow. I have put the word dividend, but look at this as the free cash flow. Just so that it sounds relevant, I have put dividend word, yes. So please understand this, that till sixth year, the growth rate is 6 percentage. So I cannot use one formula, right? Because the growth rate is changing, right? So I will have to discount each of these cash flows separately, individually, and then sum it up. And but from year 7 end, it is 6%, right? It is 6% only if you read the case. If you read the case, it says that the growth rate reaches 6%, so where it is expected to remain indefinitely. So can I say that there are two stages to calculate this. The value of the firm today is present value of all these cash flows, that is 1 to 6, the present value of cash flow at time 0, and also the present value of terminal value at time 6. So what I would do is that, yes, please ask me.
सर हमने इसमें पूरा पूरा कैलकुलेशन क्यों किया ईयर 1 ईयर 2 का, क्योंकि उसमें क्वेश्चन में लिखा है कि 14% वो ग्रो हो रहा है सारी वैल्यूज, राइट? तो हम
नहीं
डायरेक्टली
ऐसा
जो
नहीं लिखा है बेटा, ऐसा नहीं लिखा है, ऐसा नहीं लिखा है. Please read this. The expected to grow at 14% is the following year, and then it is declining 2% per year, beta. So it
नहीं
is
वो नहीं सर,
14%.
ऐसा नहीं, मैं कहना चाह रहा हूँ ईच ऑफ दीज वैल्यू इज ग्रोइंग एट 14%, राइट? देन 12% एंड 10% ऐसे करके, राइट? तो
हाँ.
हम डायरेक्टली कैश फ्लो जो हमने निकाला है तो सिर्फ उसका अमाउंट हम 14% से ग्रो करके लिख देना, मैं ये पूरा कैलकुलेशन वापस रिपीट करने की क्या जरूरत है हर ईयर के लिए?
No, understand, beta. See, the tax rate is different, so that's why it will have implications. So you are saying that you want to calculate the cash flows and you want to change the cash flows at 14%. That is what you are saying, beta?
यस सर.
Oh, that also you can do. Fine. That is absolutely fine. That is absolutely fine. Why I have done this? Because in case, let's say I give you a question in the examination where the cost is changing at a different rate and sales is also changing at a different rate and investment is also changing at a different rate. In that case, you cannot use that formula. So just so that everyone understands, that's mathematical thing, right? That the moment you understand what is happening, you can use any ways to solve it. Yes, good. Very sharp thinking and approach, but let me do this way because it becomes easier for everyone to follow, right? Yes. So yes. So now see, after this time 6, it is 6% is forever, indefinitely, right? So what I could do is that I can calculate the present value till from year 1 through year 6, and then I can calculate the terminal values for cash flows beyond year 7 or from year 7, right? So this is the formula. This is going to be the formula. Terminal value at time 6 is equal to, right? So at this point, what is the free cash flow at time 7? 34 million, right? 34,768,120. And because it is growing at a constant rate, I will use growing perpetuity formula. The cost of equity is 13% and the growth rate is 6%. So 496 million is the present value of all cash flows beyond time 6, beyond year 6, right? Beyond year 6, right? So this is one thing. And the second is that I will calculate the present value of all these free cash flows. And the sum of both is the value of equity today or value of the firm today, because both are going to be same. There is no debt, that's why. So as you could see, I have discounted all these cash flows, 20 million by 1.13, 23.256 million by 1.13 power of 2, and so on till year 6, this value, right? And then terminal value we have captured for all the cash flows beyond time 6, that is 496 million. So because it is at time 6, what is the value today? 23.85. So if I do that sum of all, the value is 34 crore 30 lakh 7,648. That is the present value of the firm. Please ask me questions in calculations at least, or conceptually, please.
सर हमने टर्मिनल वैल्यू का जो फॉर्मूला देखा था वो सर एक मिनट आप स्लाइड खोल सकते हैं?
टर्मिनल वैल्यू का फॉर्मूला फिक्स नहीं रहेगा बेटा. टर्मिनल वैल्यू का फॉर्मूला डिपेंड करेगा कि आपका ग्रोथ का एस्टिमेशन क्या है. इन दिस केस द ग्रोथ एस्टिमेशन इज 6% एवरी ईयर. व्हाट इफ देयर इज नो ग्रोथ? There is no growth, then you will use present value of perpetuity formula, right? So depends upon what approach you have or what kind of company it is and what is it is expecting beyond horizon, the terminal value formula would change. So in this case, the terminal value formula is, I have used this dividend, or dividend you call it, or cash flow. I am using the word dividend so that it is relatable to everyone. So FC, just a second, FCFF or FE, let's say, at time 7. So this cash flow, that is because I'm capturing here, you know, the formula of growing perpetuity, right? The growing perpetuity formula is at dividend at price 0, dividend 1 divided by R minus G. So if I'm calculating here at time 6, the FCFE has to be times 7 of the next period, right? And divided by R minus G, 0.13 minus 0.06. So depends upon what is the company's forecast, the terminal value calculation would change, or the formula we are using to calculate terminal value would change. So it's not anything new. The term terminal value means the present value of cash flows beyond horizon, and the method could be any method, right? Depends upon what company is expecting, right, Mayur?
And sir, yes sir, and sir ये 34 lakhs वाली जो वैल्यू आई वो 32 lakhs का मतलब सेम उसी तरीके से हम कर सकते हैं जो ग्रोथ वाला
6%. Yes. You try. Why don't you try that right now? Why don't you try that and check it, beta? It has to be the same growth rate because it is 6% only. If what you are saying is right, that the cash flows are growing at 6, 14, 10, 12, 10, 8, 6, then it has to be 6 only, right? Because these calculations are done on mostly Excel, so I don't think there must be any mistake. And so if there is a mistake, that is a clerical mistake. Conceptually, it has to match. Conceptually, it has to be right. Right, beta?
yes sir.
Yes. So this is one question. I have also mentioned what is this value. These are all cash flows, and this is terminal value. Please, guys, feel free to ask me questions. Otherwise, I would assume that you know it, and I'm not don't want to ask again and again because picking students because that is taking time, and that because of that we are getting delayed. So if you have any trouble, I will ask questions in between. I will ask individually, but not every time because that will take up a lot of time, right? And what is the share price today? So the present value today is 34 crore 30 lakh 7,648.5. We have 55 lakh shares in the market today. The share price must be 60. Share value, I think, based on this approach is 62.365027. Now, guys, this is important. Understand. So sometimes companies would like to know whether the shares are overvalued or undervalued, right? So by capturing the value using some model, the model that the company believes is the right model for them, then they will compare that with the share price. And even the investors are doing that sometimes, right? Some certain companies are doing that, right? And so I will compare the 62.36 calculated value of share with the market price of the share. And based on that, I could say that the market is overreacting or underreacting, right? Because over time that has to be based on. So again, the model is depends on me, that what kind of model I want to use, right? And second, that I should not be relying upon only one model. I should also look at the industry data. I should also look at what kind of growth is expected from my industry, my company. So a lot of information is required, right? And second, valuation changes based on the information available, based on the changes in the market, right? So if, let's say, government is saying that the interest rate would change, government is saying that the taxation policy would change, that would have changes on the input for this computation. And the moment there are changes on the input, the information you have, right, it has to have an effect on the value, right? So this is always a constant changing moving thing, right? Because things are always moving. But it also helps company knowing that whether the prices are overvalued or undervalued. And you can look at multiple models just to get it right, maybe, right? Let us look at the second question, guys. The second question is using multiples model. Suppose instead that you estimate the terminal value of the company using price earning multiple. Now see, Mayur, you can see now in this case the terminal value is calculated using multiples model, price earning ratio multiple model, right? The industry price earning multiple is 11. What is your new estimate of the company's stock price? So the only change we are going to do now is that change in the terminal value. So in the last case, the terminal value was calculated using dividend growth model. Now in this case, we will calculate terminal value using multiples model. So it says price earning ratio is 11 times. So what is the earnings? 56 million. See in the at time 6. So and it should be 11 times because price earning multiple is 11. Price by earning ratio is 11. So that means the terminal value must be 11 times the earnings at time 6. So that is the only change in the terminal value. And now you will discount 626. That is 62 crore 60 lakh 96,285. The rest would be same, right? It would be added into the moment you calculate the present value. It would be added, and then you divide by 55 lakh to arrive at share price. Yes. Please ask questions,
ये
guys.
ये वाला वापस समझा सकते हैं मतलब प्राइस अर्निंग रेशियो से कैसे इसने कैलकुलेट किया सिर्फ वो वाली पॉइंट
Beta, if you could help me read the question, beta, please.
यस सर सपोज instead of the
I'll just take a sip of water. You can read, but please.
yeah suppose instead that you estimate the terminal value of the company using PE multiple, the industry PE multiple is 11. What is your new estimate for the company's stock?
So now tell me, what is company expecting in terms of terminal value? What company believes that the terminal value, if we use PE multiple, it should be 11 times the earnings. Is that what it means, beta?
सर अर्निंग्स थोड़ी सर प्राइस का 11 टाइम होना चाहिए ना
नहीं, प्राइस अर्निंग रेशियो का फॉर्मूला क्या है बताइए मुझे.
प्राइस मार्केट प्राइस अपन अर्निंग्स सॉरी अर्निंग्स अपन मार्केट प्राइस आई थिंक
No, price divided by earnings, beta. Price divided by earnings. So that means the price is in the numerator, the earnings are in the denominator. That means the price is certain times, 11 times than earnings. So if I put earnings in the denominator, and if I know the answer 11, can I cross multiply and calculate the price today, the value today at time 6? Of course, right, beta? Sure, Mayur. So I'll just use the price, earnings, and I know the answer.
सर बट अर्निंग इस केस में ये नेट इनकम तो कंपनी की अर्निंग है ना मतलब शेयर होल्डर की अर्निंग थोड़ी है
The price earning ratio has a limitation that it uses earnings available to the equity shareholder, accounting earnings. So let us not change the because the information is given price earnings. So let us go with the price earning formula only. Let us not become the owner of this company and change it. That is what I'm saying. Let us, because the model, the 11 times is given on earnings, so let us use earnings only, accounting earnings only, beta. Right, beta?
यस सर
Because the word earnings means earnings to the shareholders, accounting earnings. So I know earnings now. I will multiply with this with 11, and that would be the price. So at time 6, the terminal value is 626 million, I think, right? So now I will calculate the present value of that. So that is 30 crore 7 lakh or 300 million, and that would be added into remaining cash flows present value. So that comes to 40 crores 51 lakh 65,000 something divided by 55 lakh, that is share price. Right, beta?
यस सर नाउ गॉट इट
Yes. So there is a term called enterprise value. So what is enterprise value? This is another name for value of the firm. Enterprise value means market value of equity plus market value of debt is enterprise value. But if company has cash, we should minus that. Can we have a discussion on this, that while you calculate enterprise value, why do you minus cash, please? Or why should you minus cash? Because that I had shared some reading on this, beta, please. Why should I minus cash, please? I will just show you the formula. This is the formula. What is the logic behind deducting the cash? Yes. Enterprise value is the value of the firm. Remember that it is not market cap or value that you see, because that is the value of equity, right? Available to the equity shareholders. Here we are talking about the enterprise value. That is the value of the firm. That is equity plus debt. So does not matter. The value of the assets does not matter how they are funded, right? Yes. Why minus cash, please? Can someone tell me? Please, anyone. Anyone? Dhruv, please. Dhruv, what could be the logic? Dhruv, Ankit, Ankita, Devesh, Devyansh, Forum.
Sir, maybe because the company can use the excess cash or the short-term investments that they have, which are highly liquid for like repaying the debt and
Great. Good answer, beta. Good answer. So, see, anyone else, please? I'm not saying whether he's entirely right or not. Please, I want participation, guys. Please. Why cash is deducted?
So cash is also deducted in the, if we calculate the value of equity and value of debt, so as the cash is asset and these are our liabilities, so we have previously included, there is some inclusion of this because the balance sheet is always balanced of the company. So the cash is already accounted, so we need to subtract it from them.
No, cash is included. That is not the reason we are deducting, but good thinking, beta, good thinking. It is deducted because, please imagine this, that what is driving the value of the business? The value of the business is driven by the assets, but not cash, because having cash in the pocket today does not create value. So the logic is that if you have extra cash, it should be used to pay off the debt if the company's value is captured today. So the idea is that because this extra cash uh, uh, is not invested anywhere, it should not be included. So it could be, because it could be used to pay the debt would shrink, and that's the enterprise value. Because when I say enterprise value, I am saying enterprise value of the business value of all the assets that may be funded by equity or debt. But cash is not an investment. Cash is not an operating investment. That's why cash is not a real investment. Cash is excess cash available in the business. The cash that company does not know what to do with it. So pay off the debt, right? So the idea is that it should be, the net debt should be included, or the cash should be adjusted against equity or debt, depends upon what is excess, because keeping cash does not really create value. That's the bottom line, right? So that is why it is.
Sir,
But good, yes.
sir, please can you share this PPT, because the PPT you have shared do not have this slide, and
Because
even
I was going to cover this today, that's why I was going to cover this today. And second, I have in the reading I had mentioned that please come after reading beta, because see, understand, Mayur, I'm preparing PPTs almost every day. I'm updating the PPT almost every day based on the response I get in the class sometimes, and based on the concept that I believe that you should know, right? uh,
okay.
so that is why I'm always changing. So I will definitely share the latest PPT with you, don't worry, right? But that is why I had shared this reading also with you, that you can read this. So please read when I'm asking you to read
So
from the
because link was not there in mail, I
मेल में था,
think.
मेल में था बेटा, मेल में था.
अच्छा,
मैंने
ओके,
आपको मेल भेजा, आपने देखा?
हाँ सर, मैंने मेल अभी वापस चेक किया, पर मुझे मतलब नहीं दिखा, मुझे वो तीन
हाँ
वो देखिए पीपीटी जैसा है, मतलब
हाँ, बट
पीपीटी
मैंने ये लिखा था तो ठीक है. बट मैंने ये इंटरप्राइज वैल्यू को पढ़ना है वो लिखा था, तो एंटरप्राइज
वो
वैल्यू
लिखा
को आप
था
पढ़ते.
सर, वो लिखा
ठीक है,
था, लिंक
फाइन.
नहीं दिया सर।
ठीक है, इट्स ओके. बट आई तो आप जब पढ़ते हो ना, ये तो टेक्स्ट बुक में भी इसको समझाया हुआ है बेटा, है ना? तो उसमें है. बट प्लीज आप थोड़ा आप कोशिश कीजिए कि मैं आपको रीडिंग भेजता हूँ तो पढ़ के आए, तो थोड़ा क्या, थोड़ा इजी हो जाएगा फॉलो करना. बट फाइन, इट्स आई विल डेफिनेटली, आई एम एनीवेज गोइंग टू शेयर दिस पीपीटी विथ यू, डोंट वरी, राइट? Okay, let us solve this question based on this what we have discussed, and I want to discuss one mini case now. And I have identified one case of Coca-Cola that I'm in the process of acquiring through the library. So the moment I'm acquiring it, I will share the link with you, and we will discuss that case. So in that case, we are going to value the firm, or value Coca-Cola, I think. So there I have two companies in my mind, Walmart and Coca-Cola. So any one of them we will value based on assumptions. And second, I will share that at least a day before, so that you can read that case. And we are going to, I want to use that case for DCF method, discounted cash flow, because dividend and other things are easier to follow, since we have been discussing on so many occasions, right? Please, how do I solve this question? Please, anyone would like to help me? Yes. Stock valuation and EV. How do you solve this?
Sir, first we have to identify the value of equity from the outstanding shares. Then we have to the value of
Here
debt.
here EV means enterprise value, huh? Don't get confuse it with equity value. Yes.
Okay, so first we have to find out value of equity. The value of debt is directly given to us of 64 million, and the cash of 21 million. We have to reduce it, assuming that it can be used to pay off the debt.
So first of all, understand. See, we are supposed. There are 17,50,000 shares given to us. Very good. Industry EV is EV by EBITDA. What is EBITDA, guys? I mean, if someone could.
So earnings before interest, tax, and depreciation.
And amortization. Like patents. And so when we are writing of intangible assets, the word we use is amortization. For tangible assets, the word we use is depreciation. So amortization are also not deducted, or you can say added back in a way, right? So enterprise value is 6.8 times than this, the industry is suggesting. What is the company's enterprise value first? That is the value of the firm. And what is the stock price per share? So first of all, we have to calculate EBITDA from this information given to us. So let us just look at this. EBITDA is sales minus cost, and because I'm saying that all these costs are before that, because there is no classification given, we are assuming that depreciation and all that is not deducted, because if they have deducted, they have to give the value so that we could add back, right? So EBITDA is 29 million. Now EV is 6.8 times. So 29 million into 6.8 times is the enterprise value, 197 million, 200,000 of course. And what is the equity value? 197, 200,000 minus 64 million plus 21 million. Why? Because you know the formula of enterprise value, right? Enterprise value is value of equity plus value of debt minus cash. So if you put the values and calculate value of equity, this is how it would look. And the price per share is equity value divided by number of shares, so 88.11. Yes, this is very straightforward, but please, if someone has question, please ask me. This is just applying the formula, very simple question, but still, if you want to ask me, please feel free. So EBITDA is given to you. From that, using the industry data, we can calculate the enterprise value, and from the enterprise value, we can calculate the equity value, and equity value divided by number of shares is the share price today. That is the second question. So 27th question, this is we have discussed. Please ask me if you have any questions, guys. Divyansh, Divesh, Ankita, Deolina Bajaj. I can see only Gaurang Saxena, Harsh Dani. Yes.
Sir, I've understood this question. Just one doubt that, I mean, when you were mentioning why do we add cash to this value?
We are not
I
adding. We are supposed
sorry,
to deduct.
subtracting. Yes.
Yes, yes.
I was joining from another device, so I guess I missed that part. If you can just repeat that?
So tell me, having the cash in your pocket, does it create value for you, beta?
Not unless it is
Invested, right? So in a way, we are looking at the asset side, but from the liability angle, right? So the enterprise value is value of equity plus value of debt minus cash, because this cash is not invested anywhere. And when I say equity plus debt is also total assets, right? Total net assets, that is assets minus the current liability, right? So company may also, so this also includes cash, and because cash is not invested anywhere, ideally this cash does not create value, so this should be used to pay off the debt. So we should add a net debt or net equity, that's why it is deducted. So the idea is that because in this too cash is also added, and because cash is not the value, because cash is cash, right? Unless cash is invested, the value cannot be arising. So having extra cash should be used to pay off the debt. That's why, beta.
Okay. Thank you, sir.
Yes. Right. So I have rearranged the formula from value of equity. That's why it is added here. So because we know the enterprise value, so there is no change in the formula. Please read the formula carefully, huh? And then we have divided by number of shares to arrive at stock price. This is 27th question. Please practice other questions. There are a lot of questions given in the textbook, so please solve all of them. 20th question, and then we will discuss the case. So we should discuss this. How much time we have? Let me just see. If we have time, then we can discuss this and then do the case. Otherwise, we can directly go to that mini case. Because this is not that difficult. I think you could practice also. We have 10:54. Okay, we do not have time. So I'm not discussing this because this is not at all difficult. YTD is year to date. So from the year till date, YLD is equity yield, right? We cannot use the word yield to maturity in this case because see, equities are residual claims, so we cannot use the word YTEM. RJW is the company's name. The symbol is also given to us. The yield to equity yield is also given. The price earning ratio is also given. The price today is also given, and the net change is also given. So last day, that is yesterday, it must have been 27.95 because it has reduced today by 0.13 minus 0.13, right? It has reduced, right? So This is the information. If you decode this information and put this in the right formula, you should be able to figure out the answer. Please, I will share this PPT. Please try to solve this on your own. And if you have any difficulty, please ask me in the remedial session for sure, right? Now I will go to the case that I want to discuss. Just a second. I will save this and I will go to Excel file. Okay. Thank you so much for pointing out that. I'm so sorry. I don't know how did I do. Okay, fine. Uh, yes, so I was saying that this is a mini case that we should discuss. Uh, this company is owned by brother and sister, and then it is a privately owned company, of course, and they have rapid growth because they are using proprietary technology that increases the fuel efficiency of its engines with very little sacrifice in performance. The company is equally owned by Carrington and Ginny. I don't know how do I read this, right? And the original agreement between the siblings gave each 1,50,000 shares of stock. Larissa has asked Dan to determine the value per share of Reagan stock. To accomplish this, they have collected some information from the industry, and there is also some additional information given that Nautilus Marine Engines negative earning, that is another competitor, were a result of an accounting write-off last year. Without the write-off, the EPS should be 2.07. So this is because of extraordinary events, EPS is low. And last year, Reagan had an EPS of $5.35. It has paid the dividend to each of them 3,20,000, so total 6,40,000. And return on equity is 21% and cost of equity is 18%. Please read this information at your this thing, and then we can start solving. So you are given the industry EPS, DPS, stock price, return on equity, and cost of equity. This R means equity cost, right? In different books they use the word R. In different books they use the word cost of K. So here it is cost for the company. So the cost as per the industry is 15%, and for you the cost is 18%, and the return on equity for you is 21%. The industry return on equity, not earnings, is 11%. Shall we go on and solve this, please? Guys, Riya, Shaurya, Ayushi Pandya, shall we solve this, guys? Ankita, Devlina, Devesh, guys, can you hear me now?
Yes,
Sorry,
sir.
Yes. So I hope you have read the case, and the case is anyways there with you in your textbook. So please read keep it with you so that we could do it and you could understand, you could follow. Okay. So I have gathered all the information in one place so that it becomes easier for us to follow. So the shares owned by each of the sibling is 1,50,000, total 3 lakh. The EPS of the company is $5.35 of our company. Remember our company, Reagan, right? Dividend distributed to him is 3,20,000, so total 6,40,000. So I can say dividend per share is 2.13. So total dividend divided by number of shares, that is 3 lakh, right? So that is 2.13. I'll zoom. So right, the Reagan's return on equity is 21% and cost of equity is 18%. You are also given the industry data, right? You are also given the industry data. So EPS is given, DPS is given, stock price is also given, average is also given, return on equity is also given, and cost is also given. And because if you remember, the case said that Nautilus had written off heavy expenditure, expenditure, and because of that the EPS is down. So without that write-off, the EPS is 2.07. That is also given in the case, right? So yes, first question is calculate the stock price using the current growth rate. Tell me, how do I go about this? How do I go about this? We have only 10 minutes, so please be very fast. Yes. How do I go about this? Yes. Stock price we have to calculate assuming that the company is going to grow at the current growth rate. So because the question focuses on dividend, we are going to value the equity using the dividend growth models, right? Anyone, please. I mean, it's not that, I mean, it looks that it is complicated with a lot of information, but it is not complicated. It's a very straightforward case, right? Okay, so for calculating the growth rate, do we require growth or not? Tell me. If you remember the dividend growth model, for any model you use for growth, whether it is growing perpetuity, growing annuity, or whatever, you need the growth rate. You require G. So what is the formula for G? Can someone help me? Hello. Hello.
New price upon old price into 100 or something like that.
Growth.
Yeah.
How do we calculate growth?
Sir, it is retention rate into return on equity.
Yes, Dhruv. Thank you, Dhruv, beta. So, Mayur and everyone, please, if you forgot that the G is what? G is driven by what? G is driven by what is retained in the business multiplied with return on equity. So the expectation you have from how much you have retained in the business, right? So you require retention ratio and you also require ROE. So ROE is given to you, see, for Reagan, 21%. But what is the retention ratio? So how do I calculate, Ankita? Tell me, beta. Ankita Majumdar, beta. How do I calculate retention ratio? And what is retention ratio, please?
Sir,
Yes,
actually,
Ankita,
I'm
beta.
trying to figure. Sir, I'm just trying to figure out.
नहीं बेटा, आप ये बहुत स्ट्रेट फॉरवर्ड आप बता सकते हो, आपको टाइम
EPS
देना.
by equity.
Sorry, beta.
EPS upon equity.
So EPS is what? EPS is
Earning per share.
So that is the earnings of the company. So out of the earnings, let's say, what is the earnings of the company, beta? 5.35. Can you follow this?
Yes, sir.
How much is distributed as dividend per share?
2.13.
So can I say remaining amount is retained in the business?
Yes.
What is retention ratio? Retention ratio or retention is what is not distributed as dividend. तो 5 रुपए और 35 पैसे में से 2 रुपए और 13 पैसे डिस्ट्रीब्यूट कर दिया है, तो बाकी का पैसा डिस्ट्रीब्यूट नहीं किया होगा. So that is, and the ratio of that is retention ratio, right? So I will just use that. So this is for Reagan, and I have also done that for industry. So see, guys, out of 5.35, 2.13 is distributed as dividend, and this is not magical, right? I have done 6,40,000 divided by 3 lakh, so that is the dividend per share. So 2.133333 like that. So the payout ratio is the ratio of this two. You can see the formula. 2.133 divided by 5.35 is the dividend payout ratio. Payout ratio is the dividend distribution ratio in percentage, right? So how much must be retained? The remaining portion, 1 minus payout ratio, right, out of 100. So 100 minus
Sir.
20. Yes, yes.
सर अभी मैं डिविडेंड पर शेयर और अर्निंग पर शेयर के बीच में डिफरेंस नहीं समझ पा रहा है. यानी अर्निंग पर शेयर कंपनी के लिए होता है, राइट?
Earning per share is the earnings per share of the company, how much company has earned. But company may not distribute everything as a dividend, understand? तो मैं 100 रुपया कमाता हूँ, बट जरूरी नहीं कि 100 का 100 मैं डिविडेंड दे दूंगा, क्योंकि थोड़ा पैसा मैं कंपनी में रीइन्वेस्ट भी तो करता हूँ बेटा. आपको क्या लगता है हर साल एप्पल जो कमाती है सारा पैसा शेयर होल्डर को वापस कर देती है? मयूर, प्लीज हेल्प मी अंडरस्टैंड दिस.
सर ऑफ कोर्स रिटेन अर्निंग तो रखनी पड़ेगी ग्रो पर,
राइट? So retention ratio is the percentage of what is not distributed out of earnings. So out of 100 rupees, if I'm distributing 40 rupees as dividend, that is payout ratio, and retention ratio is 60% out of 100. So it is always in percentage to earnings of 100, right? Right,
Yes.
Mayur?
Yes, sir. Yes, sir. Now got it.
Yes. So payout ratio is 39.88. That is the dividend distributed. So how much is remaining? 60.12 retained in the business. अब ग्रोथ हम कैलकुलेट कर सकते हैं बेटा, आप ये फॉर्मूला यूज कर सकते हैं क्योंकि ये ग्रोथ हमेशा रहने वाला है एज पर द फर्स्ट क्वेश्चन, राइट? सो द फॉर्मूला इज at time 0 dividend 1 divided by R, or you can say cost of equity, because R is confusing sometimes. So I am using the word KE, but you can also use the word R, KE minus G. So G we can calculate now because G was not given to us. So G is 60.12 percentage into 21 percentage return on equity, that is 21 percentage. So multiplication of this two is the growth rate, 12.63 percentage. Now I will just put down the values. First of all, I will calculate the dividend at time 1 क्योंकि मुझे growth rate पता है. I know the dividend today, so I can calculate the dividend after 1 year, that is 2.40. So 2.13333 is the dividend today into 1 plus growth rate, that is the dividend 1, 2.40 divided by KE minus G. So KE is 0.21 and G is 0.1263. So if you could see the formula also, right? That is how it has been captured. So D25 is the return on equity. Yes. It is not new, guys. Don't get confused. Don't think too much. Right? This is not new. The only difference is that the information is given in a case. That's it. It is the same approach that we have applied. It is a case of growing perpetuity. So we know the formula. Price 0 is equal to dividend 1 divided by K or R minus G. We know R. We can calculate dividend 1. But without G, we cannot calculate dividend 1 and we cannot put the value for G. So what is G? G is retention ratio into return on equity. And the moment I have that retention ratio 60.12 percentage, 21 percentage is return on equity, I know G. And then I can calculate dividend after 1 year, and I can also calculate P0, 44.71, right? So this is first question. Let us look at the second question. Because the first and second questions are difficult to understand, others are just depends on the first and second question. Dan has examined that the company's financial statements as well as examining those of its competitors. Although Reagan currently has a technological advantage, Dan's research indicates that Reagan's competitors are investing other methods to improve efficiency. Given this, Dan believes that Reagan's technological advantage will last only for 5 years, and after that, the company's growth rate will likely slow to the industry average. Additionally, Dan believes that the required return on equity or return of the company uses it's too high. So he believes industry average required return is more appropriate. So two things are changing, guys. In this case, the growth rate is different for the first 5 years and the growth rate is different for the later years, terminal value. And second, the return on equity that the required return, that is the cost company has using, is too high. So let us use the industry required return and calculate the stock price. So only few variables are changing. It's 11:08, so I will discuss this tomorrow maybe, and I will also share this Excel with you so that you could understand, you could follow the numbers today itself, right? And maybe after a couple of hours after my another class is over, I'll share this with you. Please solve the first and second question, understand the first and second question. Second question I will discuss, and the third, fourth, and fifth are depends on that. So please also try to solve this on your own, so we can spend time on understanding. Then in case you have difficulty, then solving it entirely from fresh, right? And if everything goes well, I will discuss the case if the case is acquired in a day's time, right? Please ask me question if you have any. Hello guys.
सर ये बहुत complicated sums है तो can we like discuss it in detail in the next class?
हाँ, मैं बेटा डिटेल में ही कर रहा था, बट ठीक है, मैं एक काम करता हूँ देवली ना, I will share this with you, beta. See, this is not new, beta. The only change is that the question is given in a case and the information is scattered, and that is what happens in case, right?
So, but when we have so much information, it gets confusing where to use what. That's why.
हाँ सो ठीक है, तो मैं आपके साथ ये एक्सेल शेयर करता हूँ बेटा, और देवली ना ये सॉल्व करके आने की कोशिश करना बेटा, है ना, सॉल्व करना प्लीज बेटा, क्योंकि देखो यू कैन नॉट एक्सपेक्ट एवरीथिंग फ्रॉम द फैकल्टी एवरी टाइम, सी यू ऑल्सो नीड टू वर्क हार्ड. Finance is not something that you could prepare in a day or before the exam. You know this. All of you have experience. All of you know this, right? So I was just requesting that also put your give time to this subject. Enough, spend enough time on this, practice enough, and you should be doing well. I know for sure because you all have sharp brain. I can see that while you are discussing and asking questions. The only thing lacking sometimes is the practice. That's it. Otherwise, you guys are really smart. I'm not denying that. So please do that, right? So it's 11 or 10. I don't want to drag this so much. But please solve the first and second question. The third, fourth, and fifth questions are dependent on that. So not really a big deal, right? Shall we end the session, guys?
Thank you, sir.
Yes, sir.
Yes, yes. So please practice these questions, and I will also share the answer with you with the question. And practice, please. We will discuss this in the next session. Thank you. Bye.
Thank you, sir.
Thank you. Yes.
Thank you, sir.
Thank you. Yes, yes. Thank you. Bye.